Warren Buffett says, in fact, when we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. What Warren is saying is that he wants to hold great investments for the long term, if possible, forever. Warren is always trying to achieve the longest, highest compounding rate of return possible. Why? What difference does a few percentage points make? What difference does holding an investment 10 years or 25 years make? Albert Einstein called compound interest the most powerful force on earth. Warren agrees. Warren's success and his entire investment method is based on the magic of compound interest. If we started with a $10,000 investment and earned an 8% return for 10 years, we would have about $21,500. But if we had a 15% return for 10 years, our total would be almost double at $40,500. A 5% difference makes over 200% extra return on our original investment. If we held a $10,000 investment at 25% compounding return for 25 years, our investment would have grown to 265 times to $2.65 million. An 8% return would have only increased 6.5 times to approximately $68,000, or only about 1/40th the amount. So the extra 17% made a 4,000% difference over 25 years. This graph shows the difference over time that a few percentage points can make over time to our investments. Every 1% makes a huge difference over the long term. Which would you prefer? 6.5 times your money after 25 years or 265 times your money? We can also see that the return is increasing faster over time. That is why the graph slopes upwards. Let's take a look at the change from year 9 to year 10 and from year 24 to year 25. At 8% return, the increase from year 9 to year 10 is $1,599.20. At 15% return, the increase from year 9 to year 10 is $5,276.81. At 25% return, the increase from year 9 to year 10 is $18,626.45. Remember, that's on our original investment of $10,000. So in year 9, at 25% compounding a year, we get 180% our original investment. At 8% return, the increase from year 24 to year 25 is $5,072.94. At 15% return, the increase from year 24 to year 25 is $42,937.76. At 25% return, the increase from year 24 to year 25 is $529,395.59. Remember, that's on our original investment of $10,000. So in year 24, at 25% compounding a year, we get 5,200% our original investment. We can see that not only does the increase in interest rate greatly increase our return, but also over the long term, the amount of increase in return gets bigger and faster. That's why Warren doesn't invest for the short term. Warren doesn't make his great returns by selling in year 1 or year 2 of an investment. Warren's real profits are made by holding the investment for the long term. And the longer he holds a great business, the more he makes. That is why Warren is always looking for businesses he can invest in that will have long-term high rates of growth in earnings and high rates of return in equity. The longer his investment time in the business and the higher its annual return, the more profitable the investment is. How does Warren Buffett make sure his investment can grow for 10 years or 20 years or more? He uses all the information he gathers on the company and the principles in this course to decide if he believes the company he is buying can maintain its competitive advantage for at least 10 years, ideally longer. If he believes the company can maintain its moat, he uses the average earnings growth and the average return on equity to calculate what he thinks the company will be earning and worth in the future. Here's a key point. How long Warren can hold an investment and the percent return make a huge difference. Compounding interest is at the heart of Warren Buffett's investment strategy. He is trying to get the longest and highest compounding rate possible. How does he do this? By selecting businesses that can maintain a high return for a long time. All the other checks and principles Warren follows are based on this core idea. They help him find the kind of investment that can compound long-term at high rates. If you can do it, you will make huge returns. It's simple, but not easy. Here's a real Warren Buffett case study. Throughout 1988 and 1989, Warren bought over $1 billion of Coca-Cola shares. His $1 billion in shares grew to over $11 billion in 2000, and he got paid $1 billion of dividends during that time. That's the same as if you had invested $10,000 in 1989 into Coca-Cola shares, and it grew to over $110,000 in about 11 years, and you would have received an extra $10,000 in dividends during that time too. Warren looks for the maximum return possible, and that's a 23% annual compounding return on investment, which is great. Compare that to the Dow Jones Industrial Index, which went from $2,753.20 in 1989 to $10,786.85 in 2000. If you had invested $10,000 in 1989 into the Dow instead, it would have grown to just $39,000 in about 11 years. Compounding at 23% instead of 13% meant that within 11 years, the investment in Coca-Cola was worth 3 times more. Time and the rate of return make a huge difference to Warren's investment performance over the long term.